So superannuation, I guess at least this part of the conversation, it's about tax. So forget investments. Investments come later. Superannuation, as far as we're concerned at this point, is all about tax. Tax incentives, not investments. And I guess the government appreciates, and we can all probably appreciate, by and large, we're all pretty lousy at thinking about tomorrow, planning for tomorrow, saving for tomorrow. The government can't afford to have us all on the age pension when we're 65 or 66 or 67, whatever that age pension age might be for you. The government can't afford for us all to be on the age pension, so they need to do something about incentivising us to try and save for our retirement, and they do that through the superannuation system. It all comes down to tax. So if the incentive there is to pay a whole lot less tax, some people will take up that option. Together with the forced savings, the 9.5% that may very well soon be 10% of income going in, means that most people, if they don't do anything other than just work in an employed role, they'll probably retire with a pretty decent super balance if they've had super for their whole life. But it's all about tax incentives. This is not about investments. Tax incentives. So if we put some numbers on here, we represent superannuation by this bucket. Think about it's a bucket that you're topping up through your working life. We do it via a bucket, and just putting some numbers on here, we've said, for example, if someone had $1 million in their superannuation bucket, if that bucket earned $100,000 in income in that year, so I think if you were working and earned $100,000 in income, the amount of tax that you would pay on your $100,000 of income. If instead your super fund earned $100,000 in income, it's only going to pay 15%, maximum 15%, depending on the mix of that income. It might be a little bit less, but a maximum of 15% or $15,000. So that's a whole lot less income tax that your superannuation fund pays than what you would pay as an individual. Now, that sounds pretty good. If we go to the kind of the end of the whole purpose of the super system in the first place, it's to encourage people to build up some money to use to support themselves for retirement. That retirement mechanism is known as a pension. So when you get to a certain age, and I'll get into the detail on that in a second, but you get to a certain age, you can access your superannuation by what's called a pension, in the form of what's called a pension. And there's some extra magic that happens. This tax rate up here at 15% goes to zero. Now, for anyone that's watching along and knows some of the more intricate detail, there is a cap on the amount of money you can have in a tax-free pension. Let's park that for the minute. That number's currently 1.6 million. It will go to 1.7 shortly and will be indexed up afterwards. But let's park that for a second. So you can transfer money in here to a pension. The income tax there then goes to zero, which is even better. There is no other environment where you can hold money in shares, property, cash and term deposits, cryptocurrency, or whatever it is that you want to have your money in, and pay no tax on the earnings. When you satisfy retirement, so these kind of 1, 2, and 3 that have appeared here on the side, depending on your age, the definition of retirement for superannuation is very different. So if you are 58 and retire, it is your intention to no longer work more than 10 hours a week again, gainfully employed for more than 10 hours a week again, over the age of 58. Then you're considered retired as far as superannuation is concerned. If you're over the age of 60, all you have to do is cease an employment arrangement. So you could be working full-time for BHP and you go and work for Rio, and you're over the age of 60, but your job for BHP's come to an end. You're satisfied retirement, and then the catch-all at the end is age 65. So depending on your age, there is a different definition of retirement. They get easier as you go on. At 58, you actually have to be pretty well retired, as we may well know it, in that there's no intention to work too much again. Over age 60, you could be doing 100 hours a week when you're 62 years old and go and work from company A to company B, and satisfy retirement, or as I said, the catch-all is age 65. So when you satisfy one of those, that's when you get this tax-free pension. There is a requirement that if you start a pension, you have to take a minimum amount out. So under the age of 65, that is 4%. Once you get to 65, the financial year that you are 65 at the beginning of that financial year, it goes to 5%. And you also have access to these things called lump sums. So you can take out like a regular, often it's the pension's taken in some regular installments, monthly or fortnightly, something like that. But over and above that, you can take lump sums. Effectively, you have access to your whole balance. So if you had the $1 million in there, on the day that you retire, you can take that money all out. It kind of defeats the whole purpose of putting money into super in the first place, but you can do it. If instead you just reach the age of 58, you haven't retired, you're still working full-time, you can access one of these things called a transition to retirement pension. So as the name suggests, it's a pension designed to help you transition to retirement. It doesn't get the tax breaks, so it still pays 15%. You still have to pay 15% tax on your earnings. You don't have any access to the lump sums, and your access to the balance is somewhat restricted. So it's only between 4 and 10% that you can access, but nevertheless, you can get access to some of your money. So for those, as they're approaching age 58, one of the big drawbacks that people often criticise super is about the limited access to it. So the closer you get to age 58, access doesn't really become too much of an issue anymore. Now, before I get to this, when you're over the age of 60, so drawing this money out in the pension, or if it's a lump sum, if you're retired, over the age of 60, as it says here, I didn't comment on that. The money that you take out is tax-free. So you end up in this completely tax-free haven. There is no other way of investing in Australia that you pay no tax on your earnings, no tax on the withdrawals. It's just completely tax-free. And that's all the way back to when I introduced the topic right at the very start, was to say the government affords us these tax breaks to encourage us to save and fund our own retirement rather than be reliant on the age pension, which there's no way the government can possibly afford to pay us all an age pension. So moving on from there, so I guess that's the very end part, getting money out and the whole major benefits behind it. But how do you get money in there in the first place? So how do you get money in there in the first place? So that's this green text that I've just had appear up the top here. On the very left-hand side, there's a type of contribution that's known as concessional. Effectively, that's it's part of your wages. It's the pre-tax. So if you're an employee, your employer will be making super contributions on your behalf. They go in on this left-hand side. That's the bit that goes in as part of your wages. You can voluntarily increase that up to a maximum of 25,000 now for the higher income earners that are on 250,000 plus. If your employer is paying super contributions on your full salary, you might be being capped out already. But for anyone under that, there is the option, I guess, to either enter into salary sacrifice to top up to that 25, or as was introduced a couple of years ago, you can voluntarily, at any point throughout the financial year, just add some money into your super fund. It's a special form you need to fill in to claim that as a tax deduction, and that you get a personal tax deduction for that. That money, when it goes in, it attracts a rate of tax of 15%. So back to the government trying to incentivise us to save for our retirement. You put $1 of money into superannuation, you only pay 15% tax, whereas the marginal income tax rates are often quite higher than that. For higher income earners, this tax can be 30% if your income's right up there. There's a special threshold. If you go over, you may pay a higher rate of tax. Then there's the other type of contribution that's known as non-concessional. So that's effectively your money that you've already paid tax on somewhere along the lines. It might be money that's sitting in your bank account. It might be shares that you've got. You can transfer those into superannuation, and there are certain types of property that you can transfer in as well. Now the limits on that side are a little bit higher, but they are a whole lot less than what they were a few years ago. So it's $100,000 per year that you can put in on this side of your own money, or you can group together the current year plus the next couple of financial years and put in up to $300,000 in one go. That'll then cap you out for a few years, and you have to wait until the 3-year period is up, and you can go again if you've got more money. The thing to be mindful of, though, if you are moving things like shares and trying to move certain types of property into a superannuation fund, it is a tax event for you outside. So the transferring of shares does trigger capital gains tax when you move that in. So something to be mindful of. Cash moving in is fine. You can there's no tax on putting that in, so that super fund doesn't have to pay any tax on moving any of these types in. But you as an individual may have to pay capital gains tax if you're moving something like shares into the super fund. And that's it, I guess. So, money goes in, these green ones, the money comes out, this kind of black and blue text down here. That's Superannuation 101, a bit of a quick run through. The incentives are all there around tax. There's a whole separate discussion about how do you invest that. But for the time being, this is just Superannuation 101. How do you get the money in? What are the advantages and why? I guess as financial advisors are often criticised for just banging on about superannuation and insurance. Hopefully you're starting to understand a little bit why we tend to bang on so much about superannuation.